Hey guys, I hope you are all well. I'm well. I'm doing absolutely well. It's been an interesting day so far. I'll show you what's taking place in the market. But just before we get started, yesterday I didn't get a chance to look at the market in terms of what happened yesterday because I'm one of those guys who's taking the COVID vaccines. So I took my second jab, my second shot of the COVID vaccine. I think it's a Pfizer vaccine. Yesterday, no, I took it on Monday, actually, Monday afternoon. But yesterday I got hit by this post-COVID jab reaction, aches and pains and shivers and all sorts of things that I just had to take pain medication. And it eventually went away after the second dose of pain medication. But yeah, so that's me. I've taken my 2 shots of the vaccine as has been allowed here, and we'll see. There might be a third one. I understand. There's this Lambda virus coming up. In any case, let's have a look at today's market. I want to have a look at what's happened in the market so far. There's been very good opportunities, which I think is fantastic. Depending if you've been in the market so far, you might have jumped onto them. And if you didn't jump onto them, at least you should have seen them. And, you can just follow through as I go along. Okay, so this is the day so far on the euro. I'll look at the daily chart. What I've done, I've just created my tabs here at the bottom. I've got a tab that shows me the longer time frame, daily, weekly, etc. Both for euro and gold. And then I've got the 5-minute time frame. And I did that because I followed the especially on Monday. There's some very, very good entries on Monday that you could have made some good money. But I left all my analysis on the charts. And when I do that, they get quite messy when I go between the shorter time frame and the longer time frame. So that's why I've got that. It just makes it easier. I mean, if you can do that with your own analytics, depending on how many currency pairs you're looking at, that would be fantastic. If you're looking at a lot, then it can just become cumbersome, and you don't want to worry too much about that. So from the morning, you would have seen, if you were in the market, there would not have been much for you to enter in the fairly early part of the Asian session. You then had a breakout, just a breakout beneath that, follow through, but nothing for you to trade because, you want to then wait for a pullback, right? So you would have kind of seen that and said, okay, legitimately, we're kind of breaking beneath that. There's a bit of a pullback, breakout, but what do I trade? So if you saw that and you said, well, I'm going to trade beneath that, fantastic, put your order in the market, stop up there, you would not have been triggered. Okay. And I prefer that if I've placed an order in the market and if I'm not triggered, I get out. Just allow me to think and say, okay, what's happening? Why is it failed? Then I can jump in again. So not triggered there. Bulls try to reverse that whole pattern, strong bull candle, micro double bottom. So the bulls were strong. What do you expect? You want to see follow through. If you see follow through, close above that high, break out above it, wait for a pullback, look for opportunities to go long. But that did not happen. So what we got instead was a decent reversal by the bears, right at the moving average there. So here's first opportunity for you to have taken a trade right here beneath that. Okay, stop up here. Okay, that's the nearest technical position. If you want to be super ultra conservative, and there's no need to do that, you go to this high here last night, US session, but because they're pretty close within the vicinity, that's probably why you want to do that. But I wouldn't worry too much about that. That's why, because they're in this session on this time frame, that's nearest technical level. So you could have put your order beneath that, still in the first part of the Asian session. You'd have been triggered into your sell beneath that, okay, and your stop still there. Now, if you did that, question you got to ask yourself, you always have to ask yourself once you've got the setup, where should I be looking to take my profits? If I'm in the market, I prefer to manage the trade and see if I can get a little bit more beyond the measured move. If you're not going to be in the market, and if you prefer just to take your profit and not to worry about managing the trades, then you must just upfront put a measured move in. So you're taking the trade beneath here. And what you're saying to yourself, if the bears are strong, we've covered this many times. So do go back to the archives and look at some of the analysis we've done and spoken about. The bears break beneath here. The bears will be targeting a measured move. Measured move should be standard by now, should be part of our bread and butter. They should always have some bread and butter things that automatically should always put in. I think I've mentioned in one of the many pursuits that I've done in my life as a martial artist. I have a third dan black belt in Taekwondo. But I remember right at the beginning when I started, when I was a novice, and everything was just so you couldn't stretch out properly. There's a kick that we call dolio chagi, or roundhouse kick, is what we could call it. I hated to do it because I couldn't swivel enough, I couldn't stretch enough. It was just horrible. But my sensei said to me, George, you want to become a Taekwondo expert. This is bread and butter. You cannot get away from it. Every single training session, we're going to have to do our bread and butter kick until you get into and know how to do it. So measured moves, bread and butter. You just have to say, okay, that has to be an automatic response. So if you get into a sparring match with your Taekwondo colleagues, they know, that the dolio chagi will come. The roundhouse kick will come. It's bread and butter. So measured moves have to be bread and butter. In terms of when am I going to take profits? If I'm not in a trade, where is the market likely to react, either bounce or break through, whatever it may be. So in this case, that's a measured move right there. Now, if you're taking that trade, entry somewhere there. Okay, so that's 5-6 pips. It measured moved 9 pips, so just short of 2 to 1. So if you're trading 1%, which everyone should be trading 1%, okay, in a particular setup. When you get a little bit more experience, you can increase 2%. I wouldn't go beyond 3%, but that's going to be based on your experience. And I'm talking of a setup. I'm not saying when you see a trade like this, you immediately put the full 2% or 3%, whatever it is that you want to do, or the full 1%. You don't have to do that. Okay. Once it's set up, once you've seen your strategy and you've seen the setup and you want to execute, you need to make a decision. If for any reason you kind of say, yeah, it's setting up, but you're not quite sure, then go 0.5%, half the risk size, whatever your risk is. Okay. And when you get a second opportunity to get in, put the balance in, but stay within your overall risk profile for any particular setup. So in this case, just less than 2 to 1, 2%. I mean, if you're trading 1% and you got 2 to 1, 2%, you don't have to trade again for the day. You can just say, okay, cheers, thank you, done. Even if you trade, only put 0.5% and you get a 1% return on one trade in one day. I mean, if you just did that every single day, you're coming out to 15 to 20% in a month. But we trade because that's our business. So we keep going and picking up the money and banking it. So in any case, if you would taken your profits out there, fine. You don't jump in again. Now you got to wait. Okay. And say, okay, fantastic. Took my profits out there and the market is still moving in my direction or in the direction that I was trading in. I got to find the next opportunity to trade. What do you do now? Well, you got to say, well, okay, I've reached that. measured move, the market did not bounce or turn. So the bears are strong. There's still momentum in the market. They've broken beneath the measured move, hidden level of support, get a bit of follow through. So now I have another completely new breakout that I got to see. If the bears are strong, they might get to a measured move. So there is a breakout beneath that level. So you kind of see the breakout beneath that level. That's where the breakout is ending. When you get dodges, a set where the breakout portion is ended. And you're saying if the bears are strong, they're going to be aiming to get to a measured move. Okay. You could also, okay, once you get the pullback, but before you get to the pullback, so you've seen that, you say, okay, I got to jump in to this trade. I got to find ways to get in. But if I find ways to get in, where do I put my stop? The optimum level to put your stop is at the beginning of the breakout. But you could also put your stop at the 50% pullback. We spoke about that earlier. 50% pullback of any breakout, very, very important, absolutely important, because if whoever's created the breakout, in this case, the bears, if the bears are strong, they want to make sure that the market, which will pull back, does not pull back beyond the 50% level, because if it does, it now nullifies their case. Okay, because if you're strong, at least defend the 50% pullback level. If you don't defend it, while the bears are still in control of the market, now as a bear, you got to be cautious and say, well, why is the market not defending the 50% pullback, and why are we now breaking beyond it? If you had a bull on the other side, say, hey, hang on a second, bulls are strong enough. They have managed to break through the 50% pullback level. So now let me wait and see if I get a pullback, double bottom, there's my setup, and look at my entry, etc. So put your stop beginning of the breakout, or you can put your stop just above the 50% pullback, because you're saying if the market goes beyond the 50% pullback, I don't want to be in it. That's why you put a stop in the market. Stop is just your automated way of saying if market goes beyond this level, I don't even want to have to think about it, because I might start doubting myself. That's why we always put stops in the market. Okay, that's why we always put stops in the market. That's what I recommend. Always put a stop in the market, and you can set it up. Setting up, you can. The market is moving, even if you trade in a breakout strategy and just going to sell the close. Before you do that, I mean, you've got your order ticket open, your stop in place. You could always, you have your stop loss in place, bang, bang, bang. As soon as the market moves your way, just sell. But you always have a stop in the market. So in any case, if you're down here and you're trying to find ways to go through, to get it, here's an opportunity. Inside candle, breakout mode, put your order beneath that. And if you're triggered, you kind of say, okay, the height of that pullback, sideways, trading range pullback to the 10 EMA, the height of it, if we break beneath that, the market might get there. So you're trying to get to there. Okay, so depending, let's say you were triggered, it's probably a third return, which is fantastic. You keep collecting, keep collecting, keep collecting. End of the day, you'll have a nice bag of gold, or euros in this case, that you can take home with. So if you didn't get triggered there, as I said, I like to take it out and say, well, what happened? Why didn't you get triggered? We're still beneath the 10 EMAs. If I see another setup, I'm going to get in. Get another setup there. It's a pullback, it's a breakout, it's a pullback. I'm expecting that the market will go to the measured move. Also, the other thing I didn't put in, and you may ask yourself why I didn't put it in, is if we have a first leg, pull back, get a second leg. Well, if the market is pulling back in a sideways, in a trading range, then your measured move and your first leg pullback are the same. So what I mean, there's the expansion tool. So if you say, no, there's my first leg, okay, there's the first leg. Got a few things happening here. Okay, let me just move my measured move a little bit this side so you can see clearly. Okay, there's the first leg up to there. So the first leg has ended. And if the bears are strong, they're going to want to put a second leg. But we're not getting a pullback to a moving average up there. We're going sideways. Okay, so our pullbacks are the very same level as the end of the breakout. So in the same vicinity, you can put it in until you get trained yourself on how this works. So you're saying at this point, that's how far the market would like to go. So take a trade, and that becomes the super profits. Why is that the super profits? Well, because a trading range has been created in the pullback. So if a trading range has been created, every time you see a trading range, you always must remember the market's going to break out of the trading range, but most breakouts fail. They likely go to the extent of a measured move. So the measured move is this here that we have. Height of the trading range pullback, low of the trading range pullback for breakout. That's where we like, that's the first level of profits. Okay, so if you want to go away, take your trade, that's where you got to take it. If you want to hang around and see if you can manage it, like I prefer to do if I'm in the market, if I got the time, just set it in, put your stop in and wait. And the market starts to go sideways, get out of it with a bit of profit. So that would have been, okay, let's assume you've taken that as well. That trigger point, if you put in the full stop, 13 point, and there, so that's just a little bit more than a third. If we'd gone in at 50% pullback, it's about half. Okay, but you bank it, 0.5%, you still bank it and keep it with you. Okay, so we're 5:30. So, depending on, what you do in Asian session, those would have been pretty good trades. But this whole move at this stage, remember I always said, what happens at the average price? Okay, this trading range pullback after a breakout is an indicator of a final pullback after a breakout. So at some point, that particular trade setup is going to end. And when it does end, that's done. Then you got to wait to see what else is coming up so that you can look for other opportunities. But what's happening at the moving average is, when you get a trend break and the pattern is finished, is a question you got to ask yourself. So we have, we had a trend, clearly, breakout, pullback, second leg. So the trend has been broken. So this whole pattern is finished. Now, I got to see if the bears are strong enough, they should still be trying to get to that, even though we've had a trend line break. Or even if we go sideways, whatever the case may be, later on, there might be another setup for the bears. The thing I've got to watch is my 50% pullback, because what's the most distinctive part of the chart so far if you are here? Well, the most distinctive part of the chart so far is a breakout. And there's a 50% pullback, key level of any breakout. So you kind of saying, okay, as long as the market is hanging beneath this, the bears are strong. So let's see if we get a decent setup in order for us to continue to sell. So closes beneath the above the moving average, breakout close above the moving average, follow through, good for the bulls. So if you're thinking bullish, say, okay, so the bulls have managed to put a close above the moving average and follow through. Let me wait to see, remember our major trend reversal patterns, to see if this previous low is tested, because if it's tested and the bulls are strong enough, we're going to bounce off here. If the bulls are not strong enough, the bears are just going to break beneath that and continue selling, and then just wait for your pullbacks and sell. So the market kind of goes a little bit sideways here. We have a higher low. This low is higher than that. We have inside patterns here, which are indicative of breakout mode. So, the bears are failing to get the bulls. So the bulls want to break out, and the bears are failing to break beneath that and continue their trade at this particular time. So when you see this inside candle, okay, closing above the 10 moving average, you've got that low, higher low, that's your setup. That's a trade that you can take right there. So we have the end of a trade, broken above it, close above moving average, break out above moving average, follow through. Okay, now we wait for a pullback. Remember, we always want separation 3 to 6 candles from the setup. So we're looking to see if we can get an entry, get a higher low at our test. That's good, still a higher low. Now let's see if we can get an entry. You can buy above here, this inside candle, or you can wait a little bit above there. Now, if you do that, what's going through your mind? What's going through your mind is, if we break above here, if I'm a bull, we want to go for a measured move. And that measured move is pretty decent because it's still beneath the 50% level. You know, at the 50% level, you expect that the bulls will be repulsed by the bears defending that level if the bears are strong. So the bears are failing to break beneath here. But if you put on your bearish hat and you still want to be selling in the market, what are you going to say to yourself? Well, you know, I've made profits. I've taken my profits here and banked them. Now there's a 50% pullback. I expect to be able to get in the market again, some within there. So if I'm going to sell here, okay, which is a better price for selling than down here, I can wait for the market to get there. If you're a bull, if you get a setup, there's enough profit for you to make if the market goes your way, your direction. Most important thing is, where does the stop go? Stop goes beneath here. Okay, so you can take that, you get triggered in. If you didn't take that, you take the next candle, you get triggered in, and that's where you are aiming to go. Then, you know, you're triggered in, follow through, and the market goes sideways again, creates a trading range at this level where you're expecting a breakout to occur. Nothing for you to do. I mean, you don't close your trade at this stage unless you get, you know, successive bear candles. Then you know, okay, maybe I'm going to get stopped out. Either wait to get stopped out or come out. But you got to wait at this stage. So you wait. That's still your measured move. You're in the trade. If you're not in the trade and you see this and you see that, and that's a measured move, and you see a trading range like that, you got a choice to make. You could jump into a trade right there. Okay, as you break out above that, because you've had this trading range created here, you can now put your stop here, but you're still aiming for that level. So that might just be 1-to-1 or just less. You know, depends where you put your take profit at. But if you've waited, there's a breakout, there's a follow through, and you can see what happens here. The market creates a wedge, went up, came down, went up, came down, went up. And all the market is saying is the bulls are trying to break out above this level, measured move. Also, the 50% pullback is an area where the bears would come in, try and create selling in the market. So if you're in and they have set a take profit, bank the money. If you're not in, if you set your take profit and you want to manage it, in case you get breakout and follow through and, oh, okay, we might make bank a little bit more and then, you know, put our stop up to the correct technical level as and when the market sets up, you can do that. So either way, you know, you have to manage your trade. So if you're managing your trades and you see a wedge at a level of hidden level of resistance, which you clearly can see, then you know, okay, I can try and take my profits out. If you're not fast enough to take your profits now, that's perfectly fine. Just wait and see what happens. You have a close beneath the moving average here. Okay. So at that stage, if your stop was still here, you can put your stop up to here. In fact, when, you know, after you've taken a new trade and you've put your stop here, or if you're going to go into a new trade and you stop here, then you have to move your further stop to the new technical level. Okay. And when you see that wedge forming, you can tighten your stop up to here and wait to see what happens. Okay. In this case, you see the wedge and like, okay, I didn't take my profits out, didn't have a take profit. Let me see if I get a chance, maybe I might get something happening. You get a 2-bar reversal, you get a doji, and you have a 2-bar reversal. At this stage, if you're managing your trade, you must get out of the market. This tea is quite nice. So you must get out of the market. Now, if you've taken the profits, switch the heads now. What's happening with the bears? Okay, there's a 50% level, number one. There is a measured move of a breakout above here, number two. There's something else. Okay, this tight trend range pullback to the moving average. There's another measured move, third measured move. So all of these are hidden levels of resistance, okay, that the bears are going to come out and start to sell. So when you see 1, 2, 3, and this wedge pattern created, then you are saying, okay, fantastic. I'm now waiting for an opportunity for me to go short, okay, to sell. But you don't sell there. Remember, you always got to see. You always have to see the strategy, the setup, etc. Seen it, then now I'm just going to wait for my opportunity to get in. There's a decent enough opportunity to get in the market. And if you sell beneath that, what's the bread and butter? Measured move. And so if you break beneath that, market is likely to get down here. So you can comfortably take that trade, put your stop just above the 50% pullback, and you're aiming to get there. And you can see this huge candle is just the bull stepping out and saying, well, okay, we know there's a level here, there's a potential bounce here. Let's wait and see. If the bears are strong enough to break beneath it, but we can come out and defend that. So if you had taken that, if you're in the market and you've taken that and seen it, 7% stop, 6.5, 7, 1-to-1. So that's a decent 1-to-1. I mean, I don't know if you've been counting so far, probably 3-4% on the day so far. If you trade on 1% risk, if you go in cautiously and trade in half of that, well, it's 1.75%. So now that's finished that particular pattern, right? Now we're back to testing the low of this previous bear trend. Okay, we've reached the measured move. Okay, and we see a decent reversal setup here. It's a double bottom, an inside candle, attempt to break out by the bears, failed, another inside candle. So this is pretty decent signal indicating for us strength that the bulls have got. Okay, and if the bulls are looking strong, now we have a setup, again, strategy, trading range. I got my setup, I got a way to see if I can get into the market. You don't want to just jump in, and say, well, set up, let me jump in. You got to wait to see. Now we want to wait for our signal. Okay, happy with the double bottom. Breakout above the moving average, fantastic follow through. Now I've got to wait for pullback and see if I can get in. Now, there's an opportunity, but this is horrible because it's not a bounce, it's a dodgy, it just lowers your probability. You don't want to take that trade. But if this had been a candle, an inside candle like that, or a low test like that, you could have put your order above that. But in any case, if you did, it's always about where you put your stop. You looked at it and said, okay, I'm going to put an order above that in case I get acceleration, 60% probability, maybe it might just take off. Stop in the correct place, and then you wait. When you see all of that, you wait. Today the random distribution would have worked in your favor. You would not have been stopped out at that stage when the market turns. That's why you always want to make sure you got the appropriate stop. Don't just put a stop in when you've doubled your risk, because you're going to panic and make mistakes. In any case, so you wouldn't have been stopped out. If you had been stopped out, the strategy, the pattern, the setup is still legitimate. Absolutely nothing wrong with it. Okay, so you wait again. So now we have a higher low, close above the moving average. That's perfect, above 10, above the 20 as well. Put your entry above that. If you hadn't taken that, there's one to take. If you've taken that, you're waiting. If you've taken that one and get stopped out, you got to get in the market again. That's random distribution. If you get stopped out, you got to get in the market again. In any case, that's where you would put your order in. See, I talked a lot about putting the orders. Just slow everything down, calm, have your order ticket ready, you got your stop in place. I mean, there's absolutely enough time for you to work out roughly how much you want to risk, etc. When this candle closes, the high, just place the order in the market, stop within correct technical level, 8.89. And now you're saying, okay, if we break above this, let's go for a measured move and see what we get. That would have been a decent 2-to-1. Even if you've taken that and they say it's been stopped out at 1%, you can still make your cash. So that would have been a perfect trade. I mean, I'm really excited about what's happening in Euro for the day. Now, top of the trading range, reached a measured move. We just got to wait for more information. Let's get a quick look at the precious metal. Gold today. So Asian session. Okay, you've seen all of that. Break beneath, there's a break beneath the moving average, break beneath this tight trading range. There's follow through. You got to try and find ways to get through. You get a test of moving average, big outside candle, best to wait. You get an inside candle. There's your first opportunity to trade right here. Okay, inside candle, because you're saying to yourself, well, I can take that trade. I'm going to take that trade, stop there, market should get there, and I'll take my profits out. 14, 1-to-1. I mean, you don't know all of that is going to happen. Again, same principle. Either put your take profit in, take your 1%, bank it, go have some coffee, go and sleep, whatever. Or if you want to manage it and be vigilant, be disciplined. Just comes with practice, it's not working, let me close my trades, or just, oh, it's fantastic, it's working, let me scale in and build up my position. You can do that quite well. So that would have been the first opportunity. If you didn't take that, triggered 2-bar reversal. What happens if the moving average, breakout above the moving average, fails? Okay, it's very important. This candle by candle, bar by bar analysis is very important. It just provides you so much information. Okay, so you've got to see it. And whether you're in the market now or later, or you come back later, what happened to the moving average? We had a breakout at some point. This was a strong bull candle, but it failed, which means bulls weak, bear strong. Okay, follow through by the bulls. Okay, the bulls are strong. They must give me another follow through candle. Pull back. Okay, change my head. Bullish now. Let's wait for an opportunity. As it is now, bearish. If you put your stop in the correct place, random distribution would have worked in your favor today. You would not have been stopped out. Okay. If this had kind of gone up and broken above that level and turned, you would have been stopped out. But you get a 2-bar reversal. You got to wait and say, fantastic, I'm still bearish. If you get stopped out, don't worry about it. Because it's a business. You've got to drum it in yourself. You've got a business. And the good thing about price action trading, you are the CEO of your business. So you know exactly how to take money out of the market based on your strategies, based on the trader's equation, your risk, your reward, and your probabilities. And your strategies are written down on a piece of paper. It's clear. So you are the CEO, you are the entrepreneur, you are making the decisions. But as any business owner, that every business has got gross sales, every business has got cost of sales. Then you get your gross profit. Then after a gross profit, you got your expenses, net profit, taxes, etc. In our businesses, the trades that you lose is the cost of sales. So you will lose. You have to lose. There's no business without cost of sales. Okay? But in our business, we have to be super good by being disciplined in terms of our psychology and our mindset, and by having crystal clear strategies that say, this is the way that I run my business. You can't be trading this way today and then tomorrow that way, and then you watch some video and some guys made money trading somewhere else and say, oops, now I'm gonna trade it in, or oops, and now I'm gonna have 6 charts to look at because I get more opportunities. You can do all of that, but is that suited for you? Is that how you are configured inside? Okay. Have this strategy, understand you're going to lose, and stick to it. So if you had been stopped out here, call it cost of sales, random distribution, or cost of sales. Random distribution, I always say at best, work on 60-40, because I follow my strategy 60% of the time. I'm going to win out of 100 trades. I win 60, I'm going to lose 40. But we know that it can be more than that if you're disciplined. But work on 60-40 worst case. So it means you lose 40, right, out of 100. That's cost of sales. Fantastic. You win 60 out of 100, 60%. But if you're managing them well and you put in 1% or you scaled in, man, that's huge returns. So if you've been stopped out, fantastic. In this case, would not have been stopped out. If you have not been stopped out and you've put half the risk, 0.5, and you see another setup, you can put the balance of your risk in. Okay? So let's say I only risk 1%. And I said, okay, I'm going to put 0.5% here, stop here. Let's see what happens. Oh, and then it sets up again. I can take that 0.5% and put it in the market. Then I'm now at my full risk of 1%. Similarly, if you risk 2%, split it up into 2 or 3, whatever the case may be. So it have been triggered here, stop in the same place, trying to get to a measured move. That would have been the measured move. Okay, so here's something else. If you've seen that and you're in the trade, and that's where you've got your take profit. Let's assume you're in the market. If you're not there, fantastic, you're gone. Okay. But if you've seen that and now you get that 2-bar reversal here, you have a new measured move, you can change your TP, your take profit, and drop it down to here. You don't have to keep it there, because if the market breaks beneath here, it's going to go for a measured move, which means now you can make a lot more money on that original trade. Okay. So that's where it would have been if you're trading breakouts. When you see that, stop in the correct place, sell beneath here. What happens so quick, it's a breakout, sell the close, etc. I haven't spoken about breakout trades because I think they're good, but it's more of they're good. We'll talk about it some other time. Okay, but now we have a breakout. So if you've taken your profits out and like, oh man, I've had a breakout, didn't manage it. That's fantastic. But once I see a breakout, but I'll put my 50% pullback in. Always put the 50% pullback in. Every time you see a breakout. Last week we spoke about a news breakout, and I told you I prefer to be out of the market during news. But as soon as that news candle has closed, and if it's a distinct breakout, one candle, one bar, multiple, etc., closing on their low, I gotta go in and put my 50% pullback because I want to see what's going to happen. If it's going to continue, it'll be just a pullback and continuation, fine. But if there's a pullback, doesn't mean that in this case the bulls are in charge, until we break above the 50% pullback. So there's our 50% pullback in that area. So you can see breakout, pullback. We didn't get a decent enough entry here. Bounce off the 10 EMA, no entry for us. If we did a decent entry, we could have put the entry beneath here, stop above here, and wait to see get a measured move. So we didn't get that. We have a 2-bar reversal outside candle at the moving average. Put your order beneath there. That's at the 20 EMA. You can put your stop above the 50% pullback. Okay, or if you want to be conservative at the beginning of the breakout. So there is the actual breakout. There is the actual breakout. Yes, put your stop here. There is a breakout of yesterday's low. So that's also a significant level to put your stop above here if you want to do that. So we put about 50% somewhere here. Depending on how everything's set up, you may have been stopped out. You may not have been stopped out. If you have been stopped out, well, that's fantastic. We'll get a bounce off the 50% pullback. We get a huge outside candle. Bears are strong, but that's a bit problematic. I don't like to buy these huge candles that close beneath a lot of. It's a huge trading range. Okay, so you don't want to sell beneath huge trading range and right at a low, but the bears are strong. So what you're going to do is wait to see if you get a pullback of sorts that you can trade. We have a bounce off here, you get back, micro double bottom. Now we have a lower high setup. So we have a 50% pullback. That's a double top with a 50% pullback. So 50% pullback is a legitimate level. It's been tested, hence we have a double top. Now we have a lower high. So at the lower high, you can look to take your trade. There's a double top, test of the 50% pullback. There's a strong bear breakout. Do you want to take that? Now we have a lower high. And at the lower high, we have a decent enough pattern, inside pattern. So it's a breakout mode. Put your entry beneath that, stop above here. And you're trying to see, if we're going to get, plunk it in for you. Okay, you want to see if we'll get down here. Now, at this stage, you can say, well, that's not surprising, right? That this whole setup is a bear trying to get down here. Why would it not be a surprise for us? Because of this breakout beneath yesterday's low. If you're a bear circle, we broke out beneath yesterday's low. A measured move would take us way down there. A leg one, pullback leg two. There's a leg one. Pullback leg two would take us down here. The measured move of the breakout beneath yesterday's is down here. So it's not surprising if you're a bear to be thinking, hang on, there's where we want to go. So when you see that, you can take your trade and see if we get down there. But then you have a decent enough reversal here. If you're still in that trade, you can come out of that trade. We didn't get where we wanted to. We got to a measured move of that entry here. So if you took that entry, there's a measured move. So got an attempt by the bulls to reverse, a reversal by the bears, another lower high. You could enter beneath here, stop at this level. Measured move is optimal. If you are in here, you're trying to get here. But of course, you can see this and you hop in. But hang on. Bears are strong. Let's see if I get a follow-through candle to hit my take profit. Doesn't hit your take profit, you can come out above there. Let's see. 27, you come out above there. So that's still 2/3 profit. That's not bad at all. But if you'd taken that and gone for that, if you had put it just above measured move, which you recommend, you would have banked your money. If you hadn't banked your money because you want to manage it, and you see that reversal, it's just about half. Let's get out of that and see what happens. 50% pullback still being respected. We have a double top here. We have an attempt by the bears. So there's a double top. Let me just plonk it. I'll wait for time. Okay, there's a double top with that. There's another double top with that. Still beneath the 50% pullback. And you got to wait to see if you're going to get an opportunity. Close at about the moving average. I'll put an entry beneath that. Okay. And if you put an entry beneath that, measured move is just testing that low. So that whole bearish strength looks like it's dissipating that particular point. So you take a trade and you get wedge pullback, breakout, two-bar breakout, breakout and channel. Okay. But it's a wedge, first push down, second push. Wedge is 3 pushes, first push down, second push, 3 pushes to test that low. So if you manage the trade, like I prefer to do when I see that at that level come out of the trade, if you've set your take profit at the measured move, I mean, all of this you can see is profit taken. Okay. And we kind of going sideways. The market doesn't go sideways forever. So at this stage, you're just going to have to wait for breakout and see what happens. So both euro and gold, fantastic today. I haven't bothered to compute. Obviously, don't take all the trades. I mean, if you only took 1 or 2 on each, I mean, you should be up pretty good on the day so far. Now, what I want to show you quickly Monday was a beautiful day in the market. So if we just keep all our measured moves in mind, I'll quickly show you. Okay. Let me just check what's happening here. Yep. $23rd, okay. Okay, 23rd from when I was in the market. Let's do this. Okay, second part of the, we'll call it the Asian session. Okay, so, double bottom, trying to find ways to get in the marketplace. Market is breaking above that. We have a breakout follow through, pull back, and the question is, well, how do I get into the market? Already, bread and butter, measured move. If we break out above this pattern, so if we break out above this pattern, I'm expecting that we get to that level. So I get a decent 2-bar reversal. I mean, when you see things like this, you just close your eyes. This is what you teach your kids, This is what you teach your kids. When you see this, just call me or just press buy, whatever it may be. Decent 2-bar reversal after a higher low double bottom, follow breakout, pullback, fantastic. Okay. So entry above here, and your stop, you're trying to get to there. So if you're not going to be in the market, just put your take profit above there. If you want to be in the market, let's see how far it goes. And if you've done that, here's the other thing as well, because now you've based on that, you now have a pullback. Here is leg 1. Just measuring the first leg, that first leg, and there is a pullback and likely to go there. So, if you really want a guaranteed kind of profit, don't go for the super profits. You can take your profits out here. Taking that out, just less than 1-to-1. Or you can wait to get there, which I will give you a little bit more than 1-to-1. But let's say you took your profits out there, or you came into the market and you did a quick analysis and you saw all of that and say, hey man, fantastic. I want to find ways to get in the market. Thick blue line, 10 EMA. We have another breakout here and a pullback. And you say, no, hang on a second. Okay, bouncing off the EMA, bulls are strong. There's still a bit of that measured move above there. But in any case, if we also, okay, breakout, pullback, if we break out above that, you might get to there. So you can take that trade. Stop is down here. Okay, your stop was initially here, but now you have a breakout above that level. If you pull back, your stop is here. Move your stop up there, put your entry above there. Stop is here. And you're trying to get to the measured move, okay, which you got there. There's a decent enough measured move. Now, bulls are strong, and you say to yourself, okay, this is a distinct breakout. There is follow through. Because that's a breakout, breaking out above this high, breakout, follow through, confirmed breakout. We get a pullback, bulls attempt to resume. I wouldn't have bought that because of the bearish body, but we come back to the 10 EMA again. It's not an outside candle, it's a decent reversal candle. I'm still seeing this breakout here. I'm saying if the bulls are strong, we may want to get to that. But also we have a pattern that's forming in here. So we've gone sideways at the moving average, that low, that high. Okay, so there is a measured move. If we do break above that, market may want to get to that level. So we take that trade, stop is here. Okay, and let's see what happens. We go sideways again. We know where we're going to the 20 EMA at base, attempt to break beneath it, they reverse. This market will just go on and on. So you can't sit there and watch it. You have to decide where is my stop and place a stop in the market. So if you haven't taken any of these trades, or if you've taken them and you've moved your stop and protected some of your profits, there's another entry. You could go and take another trading range created at that level. So you can enter above there, put your stop here, you can move all your stops up to here. And you say, well, if you break above this trading range, you get to this level, hidden level of resistance, which corresponds to that, it corresponds to that, and boom, you would have taken your profits. Now, when these days come up like this, where things appear clear, you're kind of beyond your 60-40. Maybe you're 65-35 or 70-30. You have to take the trades. You have to take the trades because, sometimes just come in and these trading ranges, waiting for a setup. The setup isn't there and the market is just moving, but there's no clear setup. So you don't want to get frustrated. You just say, well, there's nothing happening. Let me leave it. Let me do something else and I'll come back. But when it sets up like this, you must take a trade. And guys ask me which session has got the best setups. All sessions have got the best setups. Here we are just looking at the Asian session. That's what we're currently looking at. Well, that's where we were. Okay, so you'd have taken your profits out in this particular area. Okay, so when you then get a break beneath the moving average and a follow through, and we break beneath, so that whole pattern that we were trading bullish, that pattern is over, and that's a high of that pattern. So we have a trend line break. We're now into our strategy called the major trend reversal strategy. As you remember, go back into the archives and just refresh yourself on it. So there's a break of the so that extends back. Trend line break, always wait to see if the previous high in terms of a bull trend is tested. And if it's tested, do we break above it? Is it a reversal? So we can look for opportunities to trade. So what do we get? That previous high is tested in the form of a wedge. 3 pushes went up, second, third. 3 pushes, wedge is very important because it's giving you information. It's saying to you, the bulls have tried something 3 times. If they try something 3 times, it fails, they'll step out of the market and the bears will jump in. That's why these wedge or 3 push patterns are very important. They may not always look like a crystal clear wedge, but you got to start looking for them towards level of support or resistance. So there is our level of resistance, 3 pushes up. Okay, so get a lower high. So it's a fantastic major trend reversal. So now, I kind of have this setup. I'm waiting for the actual signal to jump in, and let's see what you get. You then get an immediate lower high being set up. Now, you can take this trade, but you must understand major trend reversals is the only strategy that inverses our trader's equation, our probabilities. Everything else is with trend and is 60-40 or better, 60% chance of success or better. Major trend reversal is only 40% chance, which means out of 100 trades, you will lose on 60 trades. But they are bread and butter, because on the 40% that you win, you can easily get 2 to 1, 3 to 1 return. So you risk 1% on that move, you get 2%, 3%, 4% if you scale in properly. But you got to know how to manage it. So that's major trend reversal. If you manage it correctly, on the 60% that you lose, you don't always lose your full risk. Okay, so don't take a major trend reversal trade and go away to the shops or go and have coffee. That's for with trend trades. That's what you can do. Major trend reversal, you want to watch it because it can, the major trend reversal may fail. Then you just get out, which is perfectly fine. And chances are you get out with very small losses, break even with very small losses, because you just know if I don't get triggered or if it fails, I can get out very quickly. But when it moves your way, you get good returns. So there's one you could have entered in, and you kind of know, well, because it's a major trend reversal, I am expecting the market to turn here. Okay, that's what you're expecting because I'm trading a major trend reversal. Also, when do major trend reversals form? You get a trend, if it's a bear trend, get a break of the bear trend, the market starts to form a trading range. Within the trading range, that's when the major trend reversal sets up, and you're hoping that the 40% chance to make it a bull breakout and make a lot of money. If it fails, the bear trend success. Same thing with the bullish, with the major trend reversal out of a bull trend. The market is going up, just as we're having a look at it here at the moment. And then we have a break beneath the trend line, and we're expecting the previous high to be tested. When they're expecting the previous high to be tested, you are in a trading range. So major trend reversals occur within a trading range, which means if you've taken it as a major trend reversal and you want to see if you get your huge return, and you've put your measured move, like I've done here, do not get out of the trade. But don't be surprised that the market is kind of turning and bouncing off here. You know, you're in a trading range, so there's a low here, and that's the measured move. If you've traded as a trading range, same kind of setup, you just take your profits out there. But you've got to, that's got to be your strategy, right? When I'm trading ranges, I expect, I'd rather have a very wide range on the day. So there's several candles bars to get to the previous low high. It might get there in one or two, but I don't want it like this. So this is a major trend reversal, entry beneath here, and you stop there. And when you're taking there's a major trend reversal, you said, well, if we break beneath this trading range that's been formed, I'm expecting the market to get to that measured move, which would equate to my earlier breakout point here. And let me see if I get there, because if I do get there, I'm risking, call it 5, and I might get a 2-to-1, and who knows, I might get another opportunity to scale in to the market at that stage. So you take the trade and you hold on to, because you've taken it as a major trend reversal. We're trying to get that 2-to-1 or 3-to-1. Okay, the market resumes. So bounces off, a bit of a reversal, and you can say, okay, major trend reversal. Let's see what happens. If the bulls are strong, I put a bull candle, come back, maybe stop me out, but I'm gonna hold out. Resumption by the bears, inside candle, attempt to break out by the bulls, fails. I mean, at some stage of the full bull candle bounce off the 20 EMA, resumption by the bears, and it's carrying on. So at this stage, can I say, okay, my thesis is right. So I'm going to see if we get there. Get an attempt by the bulls to reverse, and you don't get, or you get, it's a high test candle. It's testing the moving average and closing below its midpoint. You could take that trade if you wanted. I wouldn't, but if it was a bear candle, just scale into the trade and aim to get there. In any case, because it's a major trend reversal, and I've got my measured moves, measured move of that, and there's my take profit area, my take profit zone. You've got to take your take profits there in a major trend reversal coming out of a bull trend, because it can reverse. So you'd have taken your profits there, 2-to-1. If you didn't take your profits there and you're managing to see this candle, it's like, man, what's going to happen? Let me wait. What happens at the moving average? Because you're in a major trend reversal alert. You see that, you got to wait to see what's happening. Okay, this is a major trend reversal alert. The market might just carry on. There has to be profit taken. Who is creating this bull candle? Well, all the guys who said, well, George says, manage your trades or take profits. I'm taking take profits as all the other institutions and big banks and whatever else is trading. I'm going to take profits here and see what happens next. That's what's created this. So, if you stayed in and say, okay, for taking profits, the bulls are strong, then it just carries on. Then the bears resume. Then you get a double bottom here. At that stage, if you're still in, you want to take your profits, because if the bears are strong and this was just taking profit level, there'll be follow through. Okay, opportunities for you. If you didn't do that and you see an outside candle and you see that, you got to get out. So you didn't have time for you to get out, but you could have made a decent 2-to-1. All right, guys, very exciting opportunities in the market. But I think, just jump in, stay calm, manage the mind, manage the strategies, take your money out of the market. We shall see you next week. Thank you. Have a good time. Thanks to the guys in the office.